Silicon Valley Bank was a pillar for the venture capital and startup community.
It is the epicenter of tech startups, venture capital. Silicon Valley Bank, it is the 16th largest bank, or it was, in the United States. End of 2022, it had $175 billion in total deposits.
And one of the key things Silicon Valley Bank is about is working with startups, working with entrepreneurs in Silicon Valley and around the world.
You know, Peter Thiel is a billionaire venture capitalist. His founders fund pulled their money from SVB and encouraged its companies to do the same.
Insiders at Silicon Valley Bank sold more than $84 million worth of stock just over the past 2 years.
Silicon Valley Bank says it lost $1.8 billion in sales of securities in an effort to raise funds.
This is the biggest bank failure since 2008, and this evening so many customers demanding to know, where is our money?
All our money is in the bank. I don't know how we're going to do our payroll. I don't know what we're going to do now.
That California banking regulators have moved to now shut down Silicon Valley Bank.
U.S. banks have lost over $100 billion in startup value.
Silicon Valley Bank just died. It's the biggest bank failure since Washington Mutual in 2008, but Silicon Valley Bank is no ordinary bank. It's a Silicon Valley, darling. It had $212 billion in assets, and it counted some of the biggest names as its customers: Circle, Pinterest, Shopify, Roku, Andreessen Horowitz, and Rippling. The idea of the Silicon Valley Bank was hatched at a poker table, and it died in a gamble on interest rates. And it was a single phone call from New York that led to the ultimate demise of Silicon Valley Bank.
This video is brought to you by Houzeo, America's most advanced home buying and selling platform. Americans across the nation are saving on commissions with Houzeo.com. You can too. Check out Houzeo.com on the web or the Houzeo mobile app.
Silicon Valley Bank was founded by Roger Smith, Bill Biggerstaff, and Robert Medeiros on October 17, 1983. They discussed the idea at a Friday night poker game. The idea was to create a commercial bank that would specialize in collecting deposits and lending money to early-stage venture-backed companies. In many ways, the story of the rise of Silicon Valley as a startup mecca is closely tied to the rise of Silicon Valley Bank. Soon, the bank would gain a reputation for lending to venture-backed companies that were not profitable yet. It went public in 1988, raising $6 million. By 1995, Silicon Valley Bank had about 2,000 clients, and they included big names like Cisco Systems and Bay Networks. The bank was positioned for incredible growth during the dot-com bubble. As money was pouring into early-stage startups, Silicon Valley Bank became the bank of choice for these startups to park their money. Its stock went from $3 before the bubble to more than $59 at the peak of the dot-com bubble. But then the music stopped. Along with all the tech companies, SVB stock came crashing down to below $15 in 2002. But the bank continued to focus on its core clientele. In 2002, SVB opened its private banking business to cater to wealthy venture capitalists and successful entrepreneurs. And it continued to lend to startups, supporting the innovation in California. It then expanded, primarily to other parts of the nation where the tech ecosystem was flourishing. In 2004, it announced an expansion drive to major global tech hubs: Bangalore, India, London, UK, Beijing, China, and Tel Aviv, Israel. It also grew to Canada, Denmark, Germany, and Sweden. By 2015, Silicon Valley Bank counted 65% of all US startups as its clients. The bank started offering new products to its customers. These included syndicated loans and foreign currency management. Its stock shot up to $147 in June 2015. Silicon Valley Bank continued to support the startup ecosystem around the world.
Silicon Valley Bank has been a cornerstone of the ecosystem for technology companies and life sciences companies for over 4 decades, 40 years.
And by 2019, it was well positioned to benefit from the post-pandemic venture capitalist funding frenzy that was about to begin. The meteoric post-pandemic rise. The COVID-19 pandemic changed the world. People were getting groceries delivered at home, eating dinners at home, learning at home, working from home, and working out at home. Zoom's revenue shot up 326%, DoorDash 226%, Peloton 139%, Snowflake 124%, and Etsy 111%. Many of these startups raised multi-million-dollar rounds, and many deposited them with Silicon Valley Bank. Venture capital investment in startups doubled from $166 billion to $330 billion. For the first time in history, these VC firms raised more than $100 billion to invest in startups, $128 billion to be exact. And many of these VCs banked with Silicon Valley Bank. Silicon Valley Bank's deposits grew 86% in 2021 to $189 billion. In the same year, JP Morgan's deposits had only grown 15%. A quarter later, SVB's deposits were at $198 billion. That's more than 4 times higher than 2018 levels. SVB's stock was skyrocketing. In October of 2021, it shot up to $753. Investors were ecstatic, but behind the scenes, there was trouble brewing. The fall of Silicon Valley Bank. Banks make money by holding deposits from consumers and corporations at low interest rates and lending that cash out at higher interest rates. SVB's deposits rose too quickly. Instead of lending to consumers with traditional loan products like mortgages, auto loans, credit cards, and student loans, SVB took a different approach. SVB purchased long-maturity US Treasury bonds and mortgage-backed securities. These are high-quality liquid assets, but their market value is susceptible to movements in interest rates. Silicon Valley Bank did not hedge this interest rate risk. In poker terms, the bank was all in. Silicon Valley Bank was counting on the Fed to not increase interest rates dramatically. But the US inflation was at a 40-year high. To combat this, the Fed started hiking interest rates, and fast. Between March 2022 and February 2023, the Fed hiked interest rates 8 times. Rates went from almost zero to between 4.5% and 4.75%. Startup funding dried up, increasing deposit outflows. With higher interest rates, both VCs and startups were facing challenges raising capital. Startup investments fell 32% globally and 35% in the US. VCs and startups started withdrawing cash from their deposit accounts to run their operations. Silicon Valley Bank estimated losing $14.5 billion in deposits every quarter. While their deposits were going out the door, SVB was also losing money on its assets. SVB's asset values crashed. Silicon Valley Bank had a massive investment portfolio of $120 billion. That's 57% of its total assets. By comparison, JP Morgan's investment portfolio is just 17% of its total assets. The entire investment portfolio was subject to interest rate risk. If interest rates went up, SVB's investment portfolio would decline sharply in value. By all accounts, SVB only minimally hedged their interest rate risk. SVB's investment portfolio was also long dated, with the weighted average duration at 5.7 years on December 31st, 2022. In a rising interest rate environment, long duration bonds suffer significantly more price depreciation than short duration bonds. When the Fed started raising interest rates, SVB's investment portfolio started losing billions in value. By December 2022, these losses were in excess of $15 billion. But because these assets were in SVB's held-to-maturity portfolio, the number was only in a footnote. This $15 billion unrealized loss would only grow as the Fed raised interest rates another 25 basis points in February 2023. With its unrealized loss now more than its equity position of $16 billion, the Silicon Valley Bank was basically insolvent. But it's not yet a death sentence. If there was enough time, good asset and liability management, and some good understanding of its concentration risks, SVB could still have survived, even thrived. But a phone call from New York put a clock on SVB's management, and that phone call started the spectacular demise of the Silicon Valley Bank. The phone call that brought the house down. Moody's, the prestigious New York rating agency, had Silicon Valley Bank rating at A. According to Moody's rating definitions, obligations rated A are judged to be upper medium grade and are subject to low credit risk. Wednesday, March 1st, 2023, SVB's stock price is at $283. According to CNBC, Moody's called SVB to inform them that they were going to downgrade the bank's credit rating. This single phone call started a chain of events that ultimately resulted in SVB's demise. SVB was hemorrhaging cash in deposit outflows. Its investment portfolio had billions of unrealized losses. SVB CEO Greg Becker and his team were worried that the downgrade would undermine the confidence of investors and clients in the bank's financial health. The SVB team flew to New York for meetings with Moody's and other ratings firms, and they reached out to Goldman Sachs for advice. The plan they came up with was to sell $21 billion of their investment portfolio and raise an additional $2.25 billion via a stock offering. Wednesday, March 8th, 2023, SVB stock is at $267. SVB announced its intention to raise $2.25 billion via a stock offering. In addition, it dropped a bomb. It had sold $21 billion of its investment portfolio, but at a $1.8 billion loss. SVB's $2.25 billion stock offering, led by Goldman Sachs, was also very weak. $500 million of it was pledged to General Atlantic. The remaining was unsubscribed and unpledged. Moody's downgraded SVB, but by only one notch. In hours after trading, SVB stock plunged from $268 to $163. Thursday, March 9th, 2023, SVB stock opens at $163. Silvergate Bank, a crypto-focused institution, had collapsed the day before. According to Wayne Hu,
so around 10 a.m. or so, I started hearing rumors that some of the big funds were advising their portfolio to get out of SVB as fast as possible. That includes some of the giants in the industry, like Founders Fund, Sequoia, Union Square, YC, Iconic, just to name a few.
SVB started receiving record wire requests online on its website. By 2 p.m, their website froze. Startup founders, VCs, CFOs, and other depositors lined up outside SVB branches across the nation to withdraw money. Customers tried to withdraw $42 billion from SVB on Thursday, March 9th. That's $4.2 billion an hour. Of the $42 billion of withdrawals, over $16 billion were successful. Before the day would end, SVB had a negative cash balance of $958 million. Friday, March 10th, 2023, SVB stock opens at $64. In pre-market trading, SVB stock was trading at $63.99. Shortly after, it fell to $34 a share. By 8:35 a.m., authorities halted trading in SVB stock. That morning, California banking regulators landed at SVB and shut it down. The FDIC was appointed as SVB's receiver. All FDIC-insured deposits were transferred to the newly created Deposit Insurance National Bank of Santa Clara. The storied Silicon Valley Bank was no more. Who do you think is to blame for the death of this storied bank? Is it its CEO and management who failed to assess the risks? Did you know they didn't have a chief risk officer for most of the part of 2022? Or do you think it's Jerome Powell and the Fed rising interest rates so fast? Or is it the VCs who instigated the run on the bank? Let us know in the comments below. In our next video, we'll analyze who's to blame for the death of Silicon Valley Bank, and what are the lessons learned. So like this video and subscribe. And in the meantime, watch our video on the Bombshell lawsuit that's threatening real estate agent commissions.